Before we start, I would just love if you would subscribe to the channel, add comments, and tell your friends about the channel. That would be lovely. Good morning and welcome to the lockdown videos. Today we're going to talk about market risk. So what's market risk? Market risk is a risk of loss due to a change in market prices. For example, you buy a bond, the value of the bond decreases, you lose money. You buy a stock, the value of the stock decreases, you lose money. So risk of loss due to a change in market prices. And that can be on equity, on fixed income, on commodities, on whatever type of assets you have on the market. How do we hedge? How do we mitigate market risk? With derivatives. So it could be swaps, options, FRAs, CFD, whatever. Now, does someone tell banks the more market risk you have, the more equity you should have in front of the risk? Yes, hopefully. The Basel Committee, since 1994, put in place in 1996, told banks the more market risk you have, the more equity you should have in front of your risk. And at the beginning, they say to measure your market risk, you must use the method called the value at risk. The value at risk is a way to measure the potential loss you have over a given horizon of time on a given period. For example, if I say I have a value at risk 1 year, 1 day, 99% of 5 million, that means I have 99% chance of not losing more than 5 million within a day, given what I've seen last year if I use the historical method. So in 1996, banks applied the value at risk method. But regulators also say not only should you calculate the risk using a value at risk, but you should also calculate a stress test. That is, what could happen in your portfolio if there was a huge stress. What's a stress test? A big shock. For example, stress test, the subprime crisis, the stock crash of 1987. It could be the bond crisis in 94. So historical stress tests, we look at the scenario of what happened at the time, say if it were to happen again today, what would the impact be? And we end up with the stress test. So in 1996, regulators say to measure market risk, you should use a value at risk and stress test. Then afterwards, Basel 2.5, they said what? You should also use stressed value at risk. And also you should take into account the correlation between counterparty risk and market risk. You might hear that under the name of IRC, incremental risk charge, or CRM, stuff like that. And now we're going to be moving on to what's called an expected shortfall. We'll see that in another video if you're interested. Voilà. So to summarize, market risk of loss due to a change in market prices. How you hedge market risks? With derivatives. And do regulators tell banks the more market risk you have, the more equity you should have in front of the risk? Yes, it could be value at risk, it could be stress test, stress VaR, RAC, CRM, expected shortfalls. There's different ways to measure market risk. Hope it was clear on market risk. Take care of yourself and see you soon. Don't forget, add comments, subscribe to the channel. Looking forward to seeing you very soon. Goodbye.